The biggest financial weapon China has against America isn't a missile, it isn't a trade tariff, and it isn't TikTok quietly turning your kids into emotionally unstable dance addicts. It's something way more boring and way more dangerous. It's a spreadsheet. Specifically, it's $800 billion worth of US government debt that China is currently sitting on. And the question that should be keeping every American up at night isn't whether China will sell it, it's what happens to you personally when they do. Because here's what nobody in mainstream financial media is telling you. China has already started selling. Quietly, slowly, methodically. Like they're trying to sneak out of a party without saying goodbye to anyone. And the consequences of that sell-off don't stay in some abstract bond market that only Bloomberg terminals care about. They land directly in your mortgage rate, your 401k, and the interest rate on basically every loan you've ever touched. But to understand why, you first have to understand how we got here. Because this story doesn't start with a trade war. It starts with the most ingenious financial arrangement in modern history, one that made both China and America extremely wealthy, and one that is now falling apart in slow motion. Rewind to the early 2000s. China joins the World Trade Organization in 2001 and immediately becomes the factory floor of the planet. American companies realize they can manufacture goods in China for a fraction of the cost and sell them back to American consumers at full price. The profit margins are obscene. Walmart becomes the world's largest retailer almost overnight. Apple builds its entire supply chain in Shenzhen, and American consumers get cheap stuff. Really, really cheap stuff. But here's the financial mechanic underneath all of that. When American companies buy goods from China, they pay in dollars. China ends up accumulating an enormous pile of US dollars. And what do you do with an enormous pile of US dollars? You can't just stuff them in a drawer in Beijing. You need to put them somewhere safe, somewhere liquid, and somewhere that generates a return. And the answer, almost by default, was US Treasury bonds. So China takes the dollars it earns from selling America everything from iPhones to furniture to the plastic containers Americans use to organize the stuff they bought from China. And it recycles those dollars right back into US government debt. And that debt purchase does something very important. It keeps US Treasury yields low, which keeps borrowing costs low, which keeps the American consumer spending, which keeps buying Chinese goods, which generates more dollars for China to recycle back into treasuries. It was a perfectly circular financial relationship. America spent, China saved, and the whole machine kept running. And this is what economists call Bretton Woods 2. The informal system where the United States runs trade deficits with export-driven economies, and those economies recycle their surpluses back into US dollar assets, primarily treasuries. It's not written down anywhere. There's no contract, no signed agreement, no handshake deal in a wood-paneled room. It just became the operating system of the global economy for 25 years. At its peak, China held over $1.3 trillion in US treasuries. They were the single largest foreign holder of American debt on the planet, more than Japan, more than the UK, more than every hedge fund in Connecticut combined. Then everything changed. But then something shifted. And it didn't happen overnight. It happened the way Ernest Hemingway described going bankrupt. Gradually, then suddenly. The trade relationship that had been the foundation of this whole arrangement started cracking. Trump's first term brought the initial round of tariffs. Biden kept most of them. Then Trump's second term turned the volume up to 11, with tariff levels that hadn't been seen since the 1930s. And simultaneously, something else happened that changed the calculus for China entirely. In 2022, after Russia invaded Ukraine, the United States and its allies froze roughly $300 billion in Russian central bank reserves, assets that Russia thought were safely held in Western financial institutions. Gone. Frozen. Inaccessible. That moment was the financial equivalent of a nuclear warning shot. Because if the United States could freeze Russian sovereign assets, every non-Western government on Earth suddenly had to ask themselves a very uncomfortable question. What's stopping them from doing the same thing to us? And China, sitting on $800 billion in US treasuries, had a very specific, very personal reason to take that question seriously. So, the slow sell-off began. And when I say slow, I mean it's been subtle enough that most financial media hasn't even connected the dots. Between 2022 and today, China has quietly reduced its treasury holdings from around $1 trillion to roughly $760 billion. That's nearly $250 billion in US debt that China has offloaded. And they've been replacing it with something very interesting. Gold. China has been buying gold at a pace not seen in decades. And they're not alone. Central banks globally have been accumulating gold at record levels since 2022, which is a very polite way of saying the world's central banks are quietly hedging against the dollar. And nobody on financial Twitter is talking about it, because it's not as exciting as whatever Nvidia did last Tuesday. Why this actually matters to you. Okay, so China is selling some bonds. Who cares? You care. Here's why. Remember what I said earlier about China recycling dollars back into treasuries and keeping yields low? Well, that mechanism works in reverse too. When China sells treasuries, it increases the supply of bonds in the market. More supply with the same demand means prices fall. And when bond prices fall, yields rise. That's just math. It's not political. It doesn't care about your feelings. And those rising yields, they're not just some number on a Bloomberg screen. The 10-year Treasury yield is the single most important interest rate in the world. It is the foundation upon which almost every other borrowing cost in the American economy is built. Mortgage rates are anchored to it. When the 10-year yield rises, mortgage rates rise with it. That's why the Fed can cut the federal funds rate and your mortgage rate doesn't budge, because the Fed controls the short end of the yield curve. The long end is controlled by supply and demand in the bond market. And when China steps back from being a consistent buyer of that long end debt, yields drift upward whether Jerome Powell likes it or not. And it's not just mortgages. Corporate borrowing costs rise. Auto loan rates rise. Credit card rates stay elevated. The cost of financing a small business rises. Every single place in the American economy where money is borrowed and lent is downstream of the 10-year Treasury yield. So when you're sitting there wondering why rates feel sticky even though the Fed has been cutting, part of the answer is sitting in Beijing, quietly selling. The doom loop nobody wants to talk about. Now here's where it gets really uncomfortable, because there's a feedback loop baked into this that almost nobody in mainstream financial media wants to explain. The United States government is currently running a deficit of roughly $2 trillion per year. That means every single year, the Treasury has to issue $2 trillion in new debt just to keep the government operational. Pay the military, keep the lights on in federal agencies, service the existing debt. All of it requires constant new borrowing. And for that borrowing to happen, someone has to buy those bonds. For decades, the lineup of buyers was deep and reliable. Japan was there, China was there, sovereign wealth funds from the Gulf were there. Foreign central banks treated US Treasuries like the safest asset on earth. But what happens when the buyers start getting picky? What happens when the lineup gets shorter? Well, yields have to rise to attract new buyers. Because if you're a foreign investor and you're worried that the US might freeze your assets someday, you need to be compensated for that risk with a higher return. So yields go up. And when yields go up, the US government has to pay more interest on all that new debt it keeps issuing, which makes the deficit bigger, which requires more debt issuance, which requires higher yields to attract buyers, which makes the deficit bigger again. It's a spiral. And it's not hypothetical. The Congressional Budget Office is already projecting that interest payments on the national debt will exceed defense spending within the next few years. The United States is already spending more to service its debt than it spends on its entire military, and that number is going in one direction. The irony of this whole situation is almost poetic. For 25 years, China's demand for US Treasuries helped the United States borrow cheaply and spend freely. And now, as that demand retreats, the bill for all that cheap borrowing is coming due, with interest. What happens next? So where does this go from here? Because this isn't a clean story with a neat ending. This is a slow-moving structural shift that plays out over years, not weeks. The most likely scenario isn't a sudden crash. It's a slow, grinding tightening of financial conditions that makes everything just slightly more expensive, slightly harder, and slightly more fragile than it used to be. Mortgage rates that were supposed to fall to 5% stay at 6.5%. Corporate debt refinancing that was supposed to be cheap stays expensive. Startup funding that was supposed to return stays muted. Housing that was supposed to become affordable stays out of reach. Not because of any one dramatic event, but because the structural buyer who used to absorb trillions in US debt every year has quietly walked away from the table. The more dramatic scenario, which serious people like Ray Dalio have been warning about publicly, is that this slow shift accelerates. That a shock, whether it's a geopolitical event, a currency crisis, or just a moment where the bond market loses confidence, triggers a rapid repricing of US debt. Yields spike, financial conditions tighten hard, and suddenly everyone is scrambling to figure out why. And the answer will be the thing that was hiding in plain sight the whole time. China. Spreadsheets. Boring. The media won't tell you this. And here's the thing that frustrates me about how all of this gets covered. Because when you turn on financial media, you get inflation, you get AI, you get whatever the Fed chairman said at his last press conference. You get the loud, visible, tweetable narratives. You don't get the quiet, structural, multi-year story about how the largest recycler of US dollars is slowly diversifying away from the asset that holds the whole system together. Because that story requires patience. It requires nuance. It requires more than a 30-second take. But that's exactly the story that matters. Because the things that are loud and visible are usually already priced in. The things that are quiet and structural are the ones that blindside you. And this one has been hiding in the data for years. Gradually, then suddenly. The bottom line. China selling US Treasuries isn't a headline event, it's a background process. It's running quietly in the background of the global financial system, the same way your antivirus software runs quietly in the background of your laptop. You don't notice it until suddenly something goes wrong, and by the time it becomes a headline, the repricing will already be happening. Your mortgage rate will already be reflecting it. Your 401k will already be feeling it, and everyone on financial Twitter will be acting shocked about something that was visible in the data for the past 3 years if you knew where to look. That's why I made this channel, because the real threats in markets don't trend, they just compound, quietly, until they don't. If you want to be ahead of the next one, subscribe and turn on notifications, because I'll keep covering the stuff that matters before it becomes obvious.